Good afternoon, everyone. Thanks a lot for joining our webinar on GCC Quick Commerce. I think we'll give it maybe 5-10 seconds and then we'll start the presentation. Okay, so let's get started. Thanks again. I think we have been doing these webinars for some time and we have kept it very closed loop. So most of you would have attended some kind of session with us on GCC Commerce. Let me move further. So my name is Sandeep. I'm the partner at Redseer. I look after Middle East and North Africa, primarily focused on the digital sectors facing consumer side in the region. With me is Abhishek. Abhishek is an engagement manager with us. He has worked a lot on quick commerce, working on multiple IPOs and deals that we have seen, and also runs our benchmark product, which goes deep into everything that you see comes from our benchmark product. A quick intro for people who don't know about us. We do four things. First is transaction advisory, which is CDDs, VDDs, buy-side, sell-side work for funds. We also do strategy advisory, growth advisory for corporates. Then we also help companies topically on cost and efficiency improvement programs. And finally, the benchmarks product, which is a quarterly update on what's happening in the industry. We have if I focus only on the quick commerce sector, we have published multiple reports in this, and if you have already subscribed to our newsletter, you would have seen some of the reports. Most of the reports we have put it on our newsletter also or on our social media platforms. Our benchmarks, maybe a quick deep dive on what we do in benchmarks. This is a subscription. This is a product that is available for subscriptions, where you get on a quarterly basis what's happening in the market, competitive landscape, how are players doing across multiple KPIs, and then unit economics in terms of profitability, matrices. A deep dive. We share it on a tool and in the Excel also. Multiple sectors that we cover across geographies. Today we are talking only on the Q-commerce sector. So what we wanted to cover today was 3 topics. First one is what we are seeing in the market itself, how we are seeing the expansion in the market and what opportunities exist beyond the typical food aggregator market that gets talked about significantly. Second, we wanted to talk about how sustainable is this sector and what are our views on the sustainability of this. And then finally, going forward, we have been talking about consolidation, what we are seeing there, and what is our current perspective on that. So the first thing, many of you have been following this sector for long. So we all have seen the food aggregator market growing significantly, right? Before 2019, the market was almost non-existent, but by 2019, it was already a respectable single-digit penetration of the food service market, reaching $3 billion, and then currently it is around 14-15 billion, and we expect it to cross 25 billion by 2030. What is important, and maybe we have not spoken significantly, is all this growth has not come at the expense of the offline food service market. If you look at on the right-hand side, the offline food service market is from 2010 to 2019 was growing at 5%, and it has continued to grow even in the last 5 years, and our forecast at the same rate. So we've not seen a significant change in the direction of offline food. All the online food is because of new use cases that online food delivery has captured. So what you see on this slide is the typical food spend, total food spend by a user who is on online food, who buys online food also. So by 2019, it was already around 25-30% of its spend was on online channel. It was around 1,000 spent per capita. In the last 5 years, from 2019 to 2015, we have seen almost 30% increase in the spend per capita of these users. But 80% of that is captured by the food aggregators. So that's where and if I go behind and if I look at 2015 to 2019, this change, which you say 30% was only 5-10%. So it was not a big change in spend per capita. It is only because of food aggregators that the spend per capita has increased. And why do we think it has increased? A, they have been able to cater to changing customer needs better. So lifestyle changes where customers wanted convenience, impulse purchases, and most importantly, we think variety. Variety has been online platforms have been able to provide variety, and that additional use cases is what led to a faster and expansion of the market rather than cannibalization of the existing food service market. Abhishek, anything here that you want to highlight?
I think nothing specific as such, but yeah, typically these are the factors that has driven the rise in the food service spend in the past 10 years.
Got it. In terms of questions, you can continue to send us questions, and at the end of it, we'll take, based on how the time permits, we'll take some of the questions also. But please feel free to ask questions and keep them coming. Now, if I look at the growth anatomy, so what you see on the left, the first chart here is the increase in food aggregator market from 2019 to 2025. 60% of the increase we think was because of increased spend, which is what I was showing earlier, that because of new use cases, consumers have started to spend more. So 60% of it was driven from that, but a significant, almost 40% was also driven by adoption, where from 2019 to 2025, new users who were not buying online started to buy online food delivery also. And tourism was a very small component at less than 5%. Tourists typically would go on offline channels and spend. But what we expect now, spend to continue. So new use cases will continue to drive. There'll be we have increasingly started to think of the three and a half meals that the consumer has rather than the current food service market, and how players will replace increasingly more and more portion of the three and a half meals that consumers buy. So we expect that spend will continue to increase. Adoption in GCC is significant, so we don't expect a significant increase on adoption, although that would be the case. And finally, now we see that the players are large enough and they've started to spend on tourism, and tourists will also start to spend on these online players. And we have, for example, Kareem, which is a ride aggregator, ride hailing app, also a tourist downloads it, but then they also spend some time and spend to order food also.
And the one more interesting thing over here is that this spend, if you look at the current state, only less than 20% of the users are ordering 7 to 8 meals in a month. So we expect going forward, the rest 80% would also started ordering more frequently from these food aggregators, which will lead to an increase in spend overall.
Yeah. So there's expansion on customer wallet, which we spoke about. We also see expansion in terms of sectors. So while food and grocery are well established, which you see on the top right, online frequency and super app preference, food and grocery are on the top right. But utility payments, pharmacy, beauty, fashion, maintenance, personal care, we see a lot of these categories from the latest consumer, that consumers are ready. It is the supply that is constrained at this point. And whenever there is a market is supply constrained and it is competitive, supply does look for additional growth, and we do feel that we'll see many of these players get into these untapped opportunities, which will lead to expansion of market. Putting some numbers to it, the food aggregator market by 2030 for GCC, we expect to be around 26 billion. Quick grocery crossing 10 billion by 2030. And then other categories like quick retail specifically, which includes pharmacy, beauty, electronics, gifts, etc. We expect that to cross 5 billion. So the market we estimate it to be around $45 billion by 2030, just on the quick commerce. The next leg for expansion, majority of the players have focused on Saudi and UAE, and they have been right because they were majority of the market historically. But we do see that the rest of GCC and more importantly other MENA markets are also emerging, and they will no longer be insignificant portions, contributing to almost 1/3 of the opportunity going forward. So we estimate a good 15-16 billion of the market to come from non-UAE, non-GCC markets, which will also lead to expansion. So one of the questions that we keep getting asked is there growth in the market? And at least what we are seeing is there is significant growth in the market left. The market is expected to at least double in the next 5 years. Now, if we look at historically, local players have captured the market well and very profitably. This is a EBITDA margin comparison, and you can see that GCC players have been relatively high profitability compared to other markets. What this has led to, especially in the last year, is increased competition. This is a slightly busy chart. I'll just explain what we wanted to say here. So 3 markets, KSA, UAE, and Qatar. And then you see for each market, 3 columns. The first column is whether a specific player lost significant market share, was it stable, which is within the 2% range, or it has gained significant market share. And this is not food aggregator, by the way. We have included both food aggregator and grocery in this, both together, what the market shares are for. So some of players who are focused only on one segment and not the other, because quick grocery also expanded significantly where they were not present, they might have resulted in loss of market share in the overall Q-commerce market. And then the rows are market leaders is the first one, challengers, and then smaller players also is the third one. So in Saudi, which is a very, very competitive market now, we have seen Kita, Ninja, and Noon come in. They have gained significant share, more than 2% over the last 2 years, at the expense of the other incumbents. In UAE, we are seeing we saw that while Kareem has been stable, Noon is the one that gained significant share at the expense of many of the other players. In Qatar, where we included Qatar this time because we saw a deal recently where Jaiz bought Snunu. So in Qatar, Talabat has been stable, but Snunu has been gaining share, and at least in the last year has gained more than 2% share in the Q-commerce market. So overall, the market has intensified. But if you look at more closely Q1 to Q2 and focus only on the food aggregator market, right? So these are the Q2 market shares for for Saudi market. Hunger Station obviously leads, followed by Jahiz. Kita now has captured around 11-12% of the GMV share. This is the volume, this is the value share in a very short period of time. So Kita is now almost roughly half of Jahiz already and a clear number 3 in the food aggregator space. But still remains significantly behind Hunger Station and Jahiz. If you look at the changes from Q1 to Q2, we see Jahiz and Kita gaining share, while Hunger Station and other players in the short term lost share, because I think right now it's slightly more promotion driven. So players who do promotions in the short term are gaining share. Anything, Abhishek, here you wanted to talk?
I think the main reason, so there has been a volatility in the market share in the past 2-3 quarters. Few of the players have gained market share in few quarters and then they have lost in few. And the main reason behind is the discount driven, right? So in the previous quarter, Jahiz, because of the promotional campaigns that they led, they were able to gain or improve their positioning in the market compared to Q1 2020.
Got it. And some color on the unit economics. So what we've done here is look at the different stakeholders, users, merchants, and riders. And for each one, what are the different margin levers that the players are pulling in, which are negative and positive. So here, as you see, we have highlighted what are the levers that are under pressure. Discounts, as Abhishek was talking of earlier. We are seeing a rise in discounts, significant discounting on menus, a delivery fee, which used to be significant, food aggregators charging delivery fee, that has gone down significantly, and players are now focused on subscription programs. So delivery fee realization has gone down. We have also seen teaser commissions where the overall commissions that restaurants pay has been reducing. And then on the rider side, we are seeing increased incentives and increased salaries. So I think overall there is pressure on these four stakeholders.
So in the market right now, all the leading players, the focus is to lock in the users, merchants, and rider, and for that, they are using these strategies where they are giving more discounts, where they are open to reduce the commission and also increasing the salary of riders so that they can retain all the stakeholders to provide value to the whole ecosystem at the expense of the merchants.
Maybe you can continue, Abhishek.
Yeah, so now we talked about how to retain the stakeholder. They were few of the players have been losing margins, but now to compensate for that, all the leading players are turning into the new revenue levers. So if we look at the users in the recent times, what we have seen is that many of the players have started partnering with the banks so that the banks can fund the discount instead of the player itself. Also, we have seen a rise in service fee. So a couple of years back, the service fee concept was not even there, or it was there, but only 1-2%. But now 5% of the fee, 5% of the AOV are being charged by a few of the players. So this is one of the key lever to offset the margin pressure. Now on the merchant side, ad revenue has been the key focus for all the players. We have seen players such as Talabat, Noon investing a lot in uh, in boosting their ad monetization features and offerings. And now on the rider side, what we have seen is that all these, because of the higher salary that they have to provide to the riders, they are trying how they can optimize the riders more or can increase the utilization rate. So we have seen an increase in zonings. We have seen a few of the players such as Jahiz who have started focusing on having their own fleet. So these are the few of the initiatives that players have taken to offset the margin pressure that market is facing right now.
I saw a question, someone asking whether the screen is visible. I hope there is a presentation being shared and the screen is visible. Please reply if someone cannot see the screen, but I will assume that it's visible. So what this means is, while in the short term we do expect that there will be pressure, there might be discounts that we saw in Saudi, and to some extent we have already seen a precursor in UAE where a lot of bank discounts, where players are tied up with banks, for example, to give card level discounts. So there is a discounting pressure, but there are significant number of levers such as advertising revenues, service fees, optimization on logistics, where uh, players will improve the logistics as they gain scale. In the medium to long term, we do expect that we will see a positive upside on the EBITDA in stable state from where it is currently. So while on sustenance, we think that the market is the first thing we wanted to talk about was that there is demand, and the demand is increasing for these convenience services, and there is significant growth. Second, in terms of sustenance, we do see short-term pressure, but there are sufficient levers that players have where they will be able to compensate in the medium to long term to come out of it stronger and increase the margins as they gain in scale. Now, I think the last section we wanted to cover was a bit on consolidation and what we are seeing there. So, a quick view on the GCC market, a regional view, and many of you might have seen this, but I'll just quickly talk about what this is. So this is QCOM market as of H1 2025. Delivery Hero is the largest, which Delivery Hero includes InstaShop, Talabat, Hunger Station. They are majority player, more than 50% market share in the region. Jahez and Snunu are the second largest. Kita has emerged as a significant player. And then we have significant players who are not very large but potentially gaining scale, which is Kareem, Deliveroo, Ninja, Noon. And then we have a long tail of players, we think. So that we feel that currently the market has a lot of players. And if we look at what this means in terms of competitive intensity, the Saudi is one of the most competitive markets in the world right now, where this is a HHI index, which means lower the number, higher is the competitive intensity. 0 means the market is hyper competitive. 1 means it's a monopoly. So Saudi is 2x the competitiveness of at least the benchmark countries that we had, while Bahrain, Kuwait, Oman, these are markets where the competitive intensity is lower. So we are seeing hyper competition in UAE and KSA, which we don't think is sustainable in the medium to long term. We benchmarked 5 markets, and the markets are in the footnote, which are non-GCC markets, to see how most of these markets have already seen hyper competition, and how these players came out, and what was the count of players that came out. The cutoff that we did was, I think, 2% for a player to be included. Anything below 2%, we excluded them. So in 2015, of these 5 markets, 2 markets were 4 to 6 players, and 3 markets were 6 plus players. And today, as of 2025, none of the markets are 6 plus players. 2 markets are 4 to 6, but majority of the markets are less than 4 players. So we think that's where internationally we have seen this happen, and we feel that this market will not be any different. Right now, we see 10 plus players in GCC. While there are multiple paths for players in terms of gaining scale, which is which is what most of the players will do. Talabat has done this. Delivery Hero has done this through acquisitions and launching new services. Jais has recently done it. Kita is doing this right now. Noon is expanding into new markets. Kareem is expanding outside of Dubai in other geographies and going in Saudi. So most of them are taking the scale leadership path, but there is a diversification path also where they would try to become super apps and launch more services. And then we do see potential for a niche opportunities also, where, for example, a player might focus only on a specific segment. To some extent, Deliveroo focuses on the premium segment right now and does it well. Or someone focuses only on a specific category, like those chefs which focuses only on bakery, or breadfast which in Egypt which focuses only on bakery. But from a scale perspective, we think that in a stable state, we should see 4 to 5 players in the GCC market. Anything, Abhishek, you want to add?
I think in general, putting these are the 10 players which are there right now, and we expect to going forward, we expect to see around 4 to 5 players emerging from the 10 players, and potentially these players might follow a different path. And I think, as Sandeep has highlighted, each has a separate journey. So for Deliveroo, it's more around niche. For the chefs, it's more around desserts, and then subsequently for players such as Kareem, Noon, which are following more a super app path. So I think in the market, what we expect to see is that the players would pick up their right set of path going forward, and keep uh, focusing on that.
So thanks a lot for joining. I'll share. I'll keep this. We also do a newsletter, so you can join our newsletter by scanning, or you can send us emails. Our email IDs are here. I'll see if there are questions at this point. So I see a question from Christopher. Abhishek, I'll read the question for you. How has the entry of Chinese companies like JD.com and Meituan affected the local players?
Are we talking about the China market or the
I
local
think
market?
local players, let's assume how is the entry of Chinese players affected the local market and local players?
I think so. Kita has already entered in Saudi, right? And with the focus on creating more value for the customers. So their focus has been to give more discounts or to provide free delivery. And because of that, they were able to gain scale and able to capture 10 to 11%. However, the customer loyalty is still an issue. We have not seen a very high retention for the Chinese player right now. So that has been a key challenge. But I think going forward, with Geeta entering into the multi-vertical offerings and trying to optimize their delivery operations, they might be able to offset the customer loyalty challenge. Now, if we talk about other geographies in GCC, every geography has a different set of, or the unique customer base. So in UAE, the customer base is quite different. So what Kita has done, or the method, or Kita has done in Saudi, might not the same playbook might not work here in UAE. So in UAE, we have seen a high penetration of subscription plans, high multi-verticality usage, as well as lower delivery uh, fee as a percentage of GMV. So I think in UAE, the playbook would be different, and similarly in Qatar, in Kuwait, the playbook would be different compared to Saudi.
I think there was a specific question on Kita entering UAE and our view on the impact. Maybe you have answered, but if you want to provide any more color, else we can move.
Yeah, I think we have covered the previous one.
Then there is a question on Are there any niches emerging where smaller players can survive without being acquired?
Think it, as I said, right, within GCC, GCC is quite diverse, be it in terms of region, be it in terms of consumer behavior, right? And we have already seen few examples, players such as Deliveroo, which has been able to grow at a steady pace because of targeting a certain type of nationality. Players such as the chefs in Saudi were also being able to grow at a steady pace because of targeting premium set of consumer segments. So in this market, obviously there going forward there will be a leaders who will drive most of the majority of the GMV, but there would be certain niche players targeting certain type of consumer cohort or certain type of offerings to cater to the GCC audience.
I think there is a question on cost optimization. So we were talking about opportunities for cost optimization on logistics. There is a question on where do you see the biggest cost optimization opportunities?
So especially in the smaller markets like UAE, we have seen that the cost optimization is already on a higher side, and the reason being is the high utilization rates and more frequent deliveries by these rider itself. But in the markets such as Saudi and others, because of spread out, because the cities are more spread out, the time that is taken by these riders are much more compared to other geographies. But all these players are trying to enhance their tech, put some zoning restrictions, and also trying to increase the order volume itself so that the whole logistic cost can be decreased.
Yeah, yeah. And I think there's one question that I see on customer loyalty also. On do we think that the customer loyalty is sustainable and is it mostly discount driven? I think there is another question. A corollary to that is during the last webinar we had spoken about Saudi consumers not being very price sensitive. However, we are observing in Q2 that Jai has adopted a very aggressive approach with free delivery, which negatively impacted margins. So do we see a shift where consumers are now responding more aggressively or more strongly to lower pricing?
I think the shift, we have already seen that shift, but this shift would be short term. So on a short term basis, we might see the loyalty to fluctuate, and these customers might open to use the new apps or the apps which are giving more discount. But especially the GCC consumers, what we have seen in the past, and we expect that going forward also the GCC customers will value the players which has which can provide more value to these customers instead just only discounts, right? So in terms of more service offerings, in terms of better experience, in terms of the quality of delivery. So I think those factors will kick in on a long term, and then the customer loyalty will shift to those platforms.
Yeah, I think maybe I'll also provide some color to this one. So, see, no customer will ever say that if a product is available at a lower cost, they will not take it. In general, if it is very visible, they are aware that a product is available for lower cost and at lower friction, then they would go for it. The question comes when at some stage lower margins will make the business unsustainable. And at that point of time, when prices start to go up, will the customer loyalty shift or will it continue? Our view, I mean, we have seen that with Amazon also, where Amazon Prime is no longer the cheapest, but their experience is so high that customers tend to stick to it. In Saudi, we still feel that customers, while price is important, but price is not the only driver for buying, and hence, uh, even when Kita has gained significant share, we think that going forward, others have also started to do the playbook. So Jahez has demonstrated that if they are able to give up a bit of margins, they can capture share. So the playbook on price competition only, I don't think is a sustainable playbook. We might see some short-term instances of players leveraging that, but in the medium to long term, the Saudi consumer, we continue to believe is not pricing is not the only thing for them, and players also will have to be sustainable in the medium term. So we do see that getting into quick commerce, expanding into newer geographies, expanding into newer offerings, that also will play an important role to capture the share of wallet for consumers. I think there is one question that I see. Kita claims to be number 2 in Saudi. What metric could they be referring to? What are Abhishek, anything that you want to talk of?
I think right now, if we look at the market, especially till Q2, we've seen that Kita is clearly a number 3 player, not a number 2 player. We can
Yeah, and
clearly see
maybe I
the.
can also provide some. See, uh, at least the metric that we are tracking, which that we have shared, which is GMV for Q2, we see them to be number 3, but there could be other matrices for a specific geography or city and for a specific time period where potentially they, on a specific KPI, which could be acquisition volume, there could be multiple matrices on which they could be number 2. Let me see if there is anything else that I've missed. Taken this. Do you see existing B&M grocery retailers also planning to enter Q-commerce with dark stores? So omni-channels or offline players, are we seeing them also planning or entering into the Q-commerce segment? And I think that's different by markets, but Abhishek, I'll let you answer first.
Sure. So I think in this market, we believe that these all offline players and the online players would coexist in this ecosystem. And there are synergies which are already being tapped by these players. So we have seen all these retailers leveraging these aggregator platforms to boost, to gain or to strengthen their online presence. However, on the going mono app, we have seen a few examples only. We have seen Carrefour has been able to crack that, and Carrefour has been growing steadily in the past few years. But the other retailers in the past or in the recent times, we have seen them stick to the partnership with the food aggregators. And through that, they have been able to gain strength, gain good presence online. But yeah, however, going forward, we expect there might be one or two players more which go on a mono app or single brand app route, but most of the other players would preferably partner with the food aggregators to unlock the online demand.
Yeah. I think there is a question on what do you think will drive long-term stickiness? Is it speed, assortment, or pricing?
I think the first one, uh, I think these parameters are quite specific, but the first one that is critical right now is the variety itself. So what we are seeing is that consumers want to order or do the shopping from a single app, not only for the food, but also for the grocery and for other verticals. So the multi-vertical offerings is one of the key factor which will drive the stickiness. And the secondly is the quality itself. So the consumers are prioritizing more uh, towards the quality. And the third one is speed, but I think speed has become a norm already in the market. All these players have been providing similar type of like at least similar type of quality of delivery service. So this might not be the only differentiators that can drive stickiness. All these three together, the variety, the quality, and the speed, all together would drive the customer stickiness going forward.
Yeah, and I think speed is increasingly becoming a right to play rather than a right to win.
Yeah.
Right? I think currently players are able to differentiate based on speed at peak times, etc. But I think that increasingly will become a right to play, and assortment and experiential elements will start playing a larger role in terms of sustainable differentiation in the market. Let me see if there is any last question. I think there is a question on, will we see country consolidation or regional consolidation? Uh, I think Saudi is the largest market in our region. So Saudi has a lot of players. So we will see some kind of uh, consolidation there. Having said that, GCC is also, other markets are also fairly large, and in parallel, we'll start seeing regional also. But from a medium term view, we do think that at a GCC level, there will be consolidation also, rather than just in country level consolidation. I think I don't see a, a lot of questions, and we are running out of time also. So I'll take a pause here. If there are more questions, you have our contact details. Please reach out to us. We'll be happy to have a chat if needed. There were also questions that came on whether we'll be sharing the presentation. We will share a version of this presentation with you. A summary of what we spoke about, we'll share as talking points also as part of it. Again, thanks a lot for joining. I really appreciate it. Thanks, Abhishek, for putting this together.
Thank you, everyone.
Thank you.
Have a good day.